Want to stay in the markets? Come on in, Marc Chandler. What's the name of your firm?
Bannockburn Global Forex.
Bannockburn Global Forex. All right, Marc. Now you think we're going to be in for these wild rides for a while now? That volatility is here to stay for a moment?
I think there's some volatility here in the market. Partly we got the Federal Reserve tightening, and you got the world looking pretty dangerous with the trade tensions, with problems happening in Europe. I think that the volatility, we should be expecting that into the year end.
So the volatility, does that mean all financial instruments? I mean, is there a safe haven? Is there some place that you go to ride out this volatility?
Well, I was thinking of the volatility in the stock market, but I think the safe place in these kind of situations is in the U.S. T-bill market, which means we're demanding for dollars. And this is the first time in the U.S. we've got cash is actually paying. T-bills actually give a yield these days, unlike, say, a year and a half ago, 2 years ago. And so I think cash, dollar cash, is a place to hang out while you get this volatility.
Speaking of the dollar, I think the dollar is the biggest headwind right now for the market. I think the biggest risk is the Fed and their ability to derail an economy and the history of derailing economies. But I think the biggest headwind is the dollar. We're at a 16, 17-month high, certainly hurting multinationals.
That's what they want us to believe.
The multinationals want us to believe that?
Yeah, because part of I'd say this is that we just had the earnings season, and many investors are concerned that the earnings potential, earnings growth has peaked. That we've had an incredible earnings growth. We had a 9-year bull market.
Right. We had that, but we did have that in the first quarter. Remember, early on, the COO of Caterpillar said, something about the high water mark. So that was a concern for the first quarter. It's a concern second quarter, a concern for the third quarter. But we're all talking about the top line has been impacted severely by the strong dollar, even though we've got 28% aggregate growth on the earnings.
Yeah, so I kind of think that a lot of corporations, they get tax advantages for properly hedging their currency risk. We expect our corporations to manage their risks, interest rate risk, currency risk. So I think that we'll find that the best thing for U.S. corporates and the multinationals is stronger world economy. And right now, the world economy, you look at China slowing down. Japan's going to report Q3 GDP later this week, likely to be contracting. The Bundesbank tells us that the German economy stagnated in Q3. So what's hurting U.S. multinationals? Weaker demand, much more, I would think, than a stronger dollar.
Yeah, a lot of them are talking about weaker demand, particularly in emerging growth countries. Now, beyond that, if the global economy is slowing down and the U.S. moat, if there is one, I don't know if you agree, maybe getting smaller, why are central banks taking away accommodation?
Well, I'm not so sure how much they're taking away accommodation. I mean, I think that
well, $50 billion a month by the Fed.
That's the Fed.
Not including rate hikes.
Right.
To your point, maybe the European Central Bank hasn't begun, but they stopped, with everything else.
Yeah, so I sort of think that if almost anybody who'd be qualified to be the Federal Reserve chair, anybody who we've seen, from Volcker, Greenspan, Yellen, I think all of them would be raising interest rates in this environment. We saw that big jump in PPI at the end of last week. We saw the week before that, we saw the jump in earnings growth. The U.S. economy requires...
We've seen jumps in PPI without jumps in CPI. So already you talked about corporate pressure or earnings pressure, right? And you want the Fed to react to PPI prices that aren't being able to being passed on to consumers. That's going to be a double whammy for these corporations. I mean, there's something to this wealth effect the Fed always said they like to do. If we have a free-falling stock market, that doesn't get them to the wealth effect.
Yeah, no, you make a good point. And I think from the Fed's point of view, they've been suggesting that the asset prices, stock market, is a bit elevated. It's very rich. And so I don't think that this idea of this Powell put, I think there is a Powell put because the Federal Reserve has to be concerned about financial conditions broadly. Yeah. But I don't think we're anywhere close to the Federal Reserve. Remember what happened in February after the 12% drop in the stock market. Fed still raised interest rates, and the economy still grew 4.2% in Q2.
Yeah, I just think they're going to have to be careful after those October 3rd comments from Jay Powell. I think people are still jittery. Hopefully, the next FOMC meeting with the press conference will get greater insight. I do want to ask you, because consumer confidence is strong. We know the labor market is super duper strong, but everyone's wondering about the housing market. It's obviously under a fair amount of pressure here. What's going on there?
Yeah, so I think a combination. I think you're right. So one of these sectors where I think would really demonstrate your point that the Federal Reserve is being a bit aggressive on interest rates, because this is an interest rate sensitive sector in almost every measure. Housing starts, new home sales, permits, people who are mortgage applications, people who are signing up to buy a house. All these are multi-year lows, 2 to 5 year lows. And I think we should expect some further weakness.
How did that happen, though?
Well, I think that partly, we're 9 years into the recovery of the housing market, the cost of housing has gone up, the value of our houses has gone up, and mortgage rates have gone up, so they're less affordable. So I think squeezing some demand and a lot of supply has been coming online, and we have to make this adjustment. But this is part of these late economic cycle behavior that's beginning to accumulate that I don't think is here quite yet, but I think it will be here in a palatable way by the middle of next year.
So is there a way then, and circling back to the Fed, that they should not only take this into account, but let us know that, hey, we do see there's some fragility. I mean, we've got there's some parts of this economy, employment to population ratio, 3.1% wage growth, the highest in a decade, that are like juggernauts. But there's some fragility laced within there, including homes. Listen, I think, and I agree with you, probably the home prices grew too fast. But by the same token, if we are getting back to the wealth effect, nothing makes us feel richer than our homes going up in value. That will get us out to the malls. That will get us to invest and start businesses. So I don't know the Fed wants to risk that free falling much more.
Right, no, I agree with you, and I think that but I think the Fed's in an awkward position. And they can't help prepare the market for a rate hike in December and say we've got these weaknesses. They point out some weaknesses in the latest FOMC statement, talked about business investment. So I think the Fed is aware of this, and I think this is why the Fed says we're going to approach neutrality. And many of the Fed presidents say approach neutrality and pause. And my guess is,
except they don't know what neutrality is.
We don't know exactly what neutrality is, but the market is telling us it's probably 1 or 2 more rate hikes away.
That wouldn't be too bad. I think we can all live with that if indeed that ends up being the case. So, listen, we covered a lot. I want to say thank you. You're really great. Appreciate it. Got to come back and pick this discussion up again.
Good. Thanks. Good luck.
All right, thank you.